Before we get into the details, let's be clear on what RemoteLO's role actually is in SBA lending. We are a broker, an intermediary. We are not the bank funding the loan. Our job is to package each file correctly, document it thoroughly, and place it with an approved lending partner. That means every file we submit must satisfy two sets of requirements: SBA program rules and the individual lender's credit policy. The standard the industry is held to in 2026 is built around three things: materiality, meaning complete and clear disclosures on everything that matters; good faith, meaning we fix problems promptly and transparently; and traceability, meaning we can show exactly what was collected, when, and why decisions were made. Good files get approved. Sloppy files get declined, or worse, they lose the SBA guarantee after closing.
The SBA 7A is our most commonly used product and the most flexible. It goes up to $5 million and covers a wide range of business needs: working capital, acquisitions, owner-occupied real estate, equipment, eligible debt refinancing, and leasehold improvements. Cash flow underwriting is required on every 7A file, including a global cash flow review where the borrower has multiple businesses or significant outside income or obligations. Personal guarantees are generally expected for all qualifying owners. On collateral, lack of collateral alone is not an automatic decline under SBA rules, but any shortfalls must be documented and addressed. One critical habit: identify the correct SBA program at the very start of the file. Eligibility rules, structure, and documentation requirements are completely different between 7A and 504. Getting this wrong early creates problems you can't easily fix later. The SBA 504 is the go-to product for owner-occupied commercial real estate, major renovations, and long-life equipment purchases. The structure is a three-way split. The senior lender takes the first lien position, the CDC and SBA take the second lien through the debenture, and the borrower brings the equity injection. The SBA debenture portion is typically up to $5 million, and sometimes higher depending on the specific program rules. One key distinction from the 7A: the 504 is not for working capital. Owner occupancy and fixed asset requirements are central to eligibility. The CDC is a required partner in every 504 transaction. Bring them in early. And the fixed-rate long-term structure on the SBA portion makes this extremely attractive for borrowers who want rate certainty. Let's talk about what good underwriting actually looks like under SOP 5010-8. The industry has moved away from relying heavily on the SBSS score and toward real commercial credit analysis. That means we need to look at the full picture of the business: historical performance and trends, management experience, industry risk, customer concentration, supplier dependencies, and a complete collateral evaluation. Where an owner has multiple businesses or significant outside income or debt, we do a global cash flow review. The minimum debt service coverage ratio is 1.1 to 1, and the file needs to clearly show how that number was calculated, what source documents were used, and whether it's based on historical, projected, or blended cash flow. If DSC is tight, we need to identify the risks and explain the mitigation. Lenders and the SBA want to see a coherent credit story, not just a number. BSA AML and KYC compliance is not a box-checking exercise. It's a federal requirement and a personal responsibility. Every file must include verified borrower identity per the lender's customer identification program. Beneficial ownership information must be collected for all required owners, and if ownership changes during processing, the information must be updated. Know your red flags: unusual fund flows, business purpose that doesn't add up, ownership you can't verify, adverse media hits, connections to high-risk jurisdictions. If you see any of these, escalate immediately. Do not try to paper over them. And one absolute rule: never advise a borrower on how to avoid reporting or verification requirements. That is a federal violation with serious personal consequences. Document every step of your identity verification process in the file. Fair lending and eco-compliance come down to one principle: treat every applicant consistently. Provide required notices on time, apply the same documentation standards to every file, and never steer or discourage an applicant based on any protected characteristic.
Your credit narrative must be grounded in business fundamentals, the 5 C's: capacity, capital, conditions, character, and collateral. Subjective impressions have no place in a compliant file. On HMDA, determine early whether the transaction triggers data collection obligations. This is particularly relevant for business purpose loans secured by a dwelling. If HMDA applies, collect the required data points and route them through approved systems. Do not guess demographic information. And if you ever observe or suspect disparate treatment in any form, escalate to compliance immediately. Do not try to resolve it yourself.
Your responsibility doesn't end at closing. Depending on the lender relationship, you may have post-close servicing coordination duties, and all of that must follow the lender's servicing instructions and applicable SBA requirements. Insurance tracking is one of the most commonly dropped balls in post-close compliance. Every file must clearly document what coverages are required, the required policy limits and deductibles, the named insured and mortgagee requirements, and the renewal dates. Here's a nuance that catches people off guard. The controlling standard for ongoing insurance compliance is the standard that was in effect when the loan was approved, not the current rules, which may have changed. If flood insurance is required because collateral is in a FEMA zone, that requirement stays in place for the life of the loan. Track renewals proactively. A lapsed policy is a compliance failure. RemoteLO conducts periodic file quality reviews, so build the self-audit habit before we ever ask. Before you submit any file to a lender, run through this checklist. Is the borrower and ownership information consistent across every form, financial, and narrative in the file? Are all fees properly disclosed with a Form 159 where required? Are identity and entity documents complete and current? Can your DSC calculation be reproduced directly from the source documents? Are all exceptions documented with a clear explanation of what was approved and who approved it? When you find errors, and you will, correct them promptly. Document exactly what was wrong and what you did to fix it, and communicate with the lender in good faith. Track any issue that comes up more than once, and put a process fix in place. Checklists, templates, and peer review are your best tools.
Let's be direct about the consequences of non-compliance. Failure to follow SBA regulations or RemoteLO's operational procedures can result in immediate termination of your agreement with us, forfeiture of any pending commissions, and, where fraud or criminal negligence is involved, reporting to regulatory authorities. These are not empty threats. The SBA takes compliance seriously, lenders take it seriously, and so do we. Every loan officer operating under RemoteLO has acknowledged these standards. Ignorance of the rules is not a defense. When you're uncertain about anything compliance-related, the answer is always the same. Contact compliance before you proceed. Never guess on a compliance question. Protect yourself, protect the company, and protect the guarantee that makes these deals work.